The following is a presentation of TFNN.
All right, welcome everybody to the Options Hour. My name is Don Kaufman, and again, this is the Options Hour where you can call in really any options, derivatives, or trade-related questions. So, give us a call here if you want to fire away a couple of questions as we get going. Of course, the number is 877-927-6648. And as usual, really, any questions related to the markets, whether it's stocks, options, futures, if you're thinking about doing an option trade and you're just not that sure exactly what you're doing, give us a call. Bounce some ideas off of us as well. And that, of course, entails, really any underlying out there. If you're bullish, you're bearish, you're neutral, we'll try to answer some questions in regards to your trading questions. So I'll give you guys kind of a quick recap of the market. I've always got like a little agenda kind of planned throughout this options hour here. But again, we rely on you calling in. Give us a call, ask a couple questions. Some fantastic callers the last couple of weeks. Feel free to call back in, 877-927-6648. All right, so for a quick recap of the markets here. Quick recap, S&P futures, of course, up 8. NASDAQ futures up 6 1/4. It's kind of been the weak one on the day. Dow futures up 60. VIX down about 86 cents in the day, so pretty large drop-off on the VIX here. Of course, the euro-U.S. dollar continuing this trend where the euro is actually relatively strong over here. Bonds are off just slightly here. And the other one that's kind of getting hammered once again is LinkedIn, down about $5 in the day, and we'll talk about some really specific underlyings as we go along throughout the course of this options hour here. But again, this call-in show, you guys don't want to listen to me the entire time. You should give a call and fire away a couple of questions, 877-927-6648. Oh, right off the bat, we are going to go to Dan in Colorado. He's got a question about swing trading. You there with us, Dan?
Yes. How are you?
Hey. Good. How's it going?
Good. Question for you. I've been doing some options, just, buying when I think it's going to go up, but with some of these big swings we've had, you get wiped out on going the wrong way. So I was just wondering what your thoughts for like a bull call spread or a bull put spread.
Sure. What's your time horizon in some of these trades?
Like 2 to 5 days.
All right. So 2 to 5 days. The first thing I'm going to tell you is if you're directional in nature, options are fantastic. Are you buying out of the money, in the money? Where are you at with which options? All right, so you're buying in the money. So what you're actually doing then, when they're in the money and they're, like, say, 80 delta or above, you're trying to mimic basically stock with less risk and less capital than the stock, which is fine. Yeah, you can definitely utilize in-the-money spreads as well and try to get some payout. The problem with the in-the-money spreads is they're not going to mature in 2 to 5 days like it would if you just bought an in-the-money call. So,
okay.
in all like due course here, I guess what I'm trying to tell you is one of the best ways to do what you're doing is either utilize like weekly options if the underlying has it, or you could use it just like you're doing in-the-money calls. I'm not opposed to using vertical spreads in the real short term. It's just that you have to kind of get that understanding that you're going to buy a vertical spread, let's say for, $1 that's in the money, and that vertical spread may be able to be worth $2, but the reality is it's only going to move by about 50 cents, whether you're right or wrong. So You're probably going to have to adjust the contract size, meaning you're going to have to trade a little bit larger than you would of just buying calls. But in the end, it's still going to reduce your risk, and it's not a half-bad way to go at all to buy some of those spreads. It's more of an adjustment phase for you to get used to trading a spread versus an individual option, and how the spreads are going to move considerably slower than would that individual option. Yeah.
It just seemed like I was just playing with the bull call spread. If you're thinking it's going to go up, seems like $2 wide spread on the SPY, say, and you think it's going to go up. If you're right, you get something, but if you're wrong, it's you don't lose as much as
So when you mention the spiders, when it comes to the spiders, you're looking to like really short term. You might want to look to those weekly, the in the money calls and the weeklies, because they jump, man. I mean, if you look at a weekly right now, there's 3 days left in this weekly here, and the 127s, which are like just barely in the money, they're trading for $3 right now, and those 127s have an 87 delta. You are not going to get more bang for your buck. Obviously, the most you're going to lose in that trade is $3. The most you can make, well, it's a lot. I mean, but an 87 delta, you can even get a 78 delta with like a $2 and change option on here, which is, I mean, it's amazing in a product like the spiders. If you're talking about individual equities, yeah, the spreads work, the in-the-money calls work. When you talk about the spiders, there's a couple different things. Number one, you can use the weeklies. You could use spreads. And the final thing is you might even want to consider, if you want a lot of bang for your buck, trading the futures. But the futures, at times, that can be an ugly thing. Futures are a double-edged sword. It's kind of an experience-level product that, people have tendency to basically dig their own grave in the futures.
Yeah, I haven't played with those. So.
Yeah.
All right.
You know what? It's just like buying or selling anything else out there. But, if you're trading 10 contracts, for instance, in the spiders, you could use options on futures, too. They're tight markets. The spreads are great. They've got weeklies on them. It's worth looking into. If you want to try to save yourself a couple of bucks in commissions, the options on futures might be a decent way to go. But again, the thing I always tell people about futures, until you trade really big in the spiders, don't consider them. It's more of a cost savings measure out there.
Right. All right.
Yeah.
Well, I appreciate it.
All right. Thanks a lot, Dan. Thanks for calling us. So, all right, just started off with a kind of a great question there in the spiders. And, there's a lot of swing traders, a lot of what we call scalpers out there. And obviously, products like the spiders, you couldn't have better, more liquid markets to trade than something like the spiders. That being said, if you ever really step up your contract size, using options on futures could even be more ideal. With that, if you were listening today, you need to give us a call, or better yet, chat in over here. I'm watching the Tiger Den, so feel free to shoot in a couple of questions, and I will read them aloud. But if you want to give us a call, 877-927-6648. We've got another caller on the line. Looks like Randy in Clearwater. Guessing that's Clearwater, Florida, and he's got a question about E-mini options.
Just to start off, I know equities, I know futures, but I have really little dabbling into the options market. Do I understand the concepts of call and puts? Absolutely.
Okay.
But I traded the E-mini and the Russell in the futures, and typically I'm in them for 3 days up to several weeks, looking on swing trades, not trying to get in and out during the course of a day or scalp something, whatever, along the way. And if you have a pretty good idea of the direction of the market, you're in good shape. Of course, as you said to the previous caller, the futures can be a double-edged. You can dig your own grave on that. If you may be right on the direction, but if it goes against you far enough, you can get into a world of hurt along the way. So I was thinking about, maybe it's safer from a financial standpoint to do it in the options market, and I had sat there and pulled up an options quotes on the E-mini. Sure. And my question, there looks like there's volume in here. There looks like there's liquidity. I really don't have a grasp for the amount of premium that you're paying on that. How liquid, I'm looking for some insight to see should I really learn more about these things or if this is just a waste of time and just an idea that probably shouldn't be considered.
Sure. So you know what? I'll kind of give you advice on both ends of the spectrum here. Number one, I love, you've traded the futures products before, and Russell futures are obviously a fairly big contract, so you in your trading career, one way or another, have definitely absorbed some risk at some point, so you understand, obviously, the risks inherently involved in the futures trading. Options actually can just mitigate some of that risk, which is exactly what you mentioned. Now, that being said, if I was taking you from just ground zero, you've never traded an option before, I'm not going to recommend you trade the options and the futures to start. It's a bigger product. It's an experience level product, and the bid offer spreads, although they're tight, you're not going to get as good of a fill as you will over in something like the spiders. So, and literally the spiders are just one of the greatest products to kind of get your kind of feet into this game in options. Now, with that, I absolutely think you should spend the time and learn everything you possibly can about the options business. The industry is moving that way. So ultimately, a few years from now, you're going to look back at this and be like, oh, it's a really good thing I learned what a vertical spread is, because you're going to be trading strategies like this on really every single product, whether it's stocks, options, futures, commodities. Even bonds now are becoming more commonplace, and you're able to utilize any of these option strategies on it. But more importantly, even if you're not going to trade the option strategies on a day-to-day basis, it's understanding things like implied volatility that you're going to make you more effective trading the underlying. So the implied volatility in the options helps you read into what the underlying is appropriately going to be, price movement in the next, let's say, day, week, year. And it'll just help you, in just infinite different levels in taking you kind of to the next level in your trading here. And I hope that's a little bit clear. That being said, again, the options in the futures market, they're great, but they have tendency to be, again, a little bit more of an experience-level product. And I tell people this all the time. Do I trade the options in the future? Yes, but the vast majority of my option volume is still trading the spiders. I like the ETFs, and the primary reason is the bid-offer spreads are tight enough that even if we get into a wildly volatile situation, I can still pop in and pop out of these trades at light speed, whereas if we get into some heavy volatility days, for instance, a big down day like the VIX is up 5 or 6 on a day, the bid-offer spreads will typically widen out. They'll stay relatively contracted in the spiders, where in the ES futures, you could get yourself into a nasty position. And that's a big deal that it may not only happen, once or twice a year, but it's a really big deal. And dealing with that, in a live trading environment is very, very difficult. And I know if you've traded some Russell futures, you've seen some of that volatility and some of those spreads, even in the actual underlying futures product, widen out from time to time.
Mm-hmm.
Yeah, and that's basically it. I cannot stress more than learn everything you possibly can about vertical spreads, calendar spreads, and options, and you'll be fine.
What would you recommend for learning the basics of options?
On the basics of options, so, obviously I'm a little bit biased here, but with ThinkorSwim from TD Ameritrade, we've got, seminars every single day on there. We do swim lessons. The guy's constantly talking about, options basics. I think on, what's tomorrow, Wednesday, Thursday, I'm doing everything about theoretical options and all the different tools and analytics. On Wednesday and Thursday, I'll do a session from, 11 a.m. Central Standard Time, both Wednesday and Thursday, but we have something going on almost every single day, and there's all kinds of archives on there. Really, you'd be able to find just a tremendous amount of free education over the net. And, ultimately, learning some of the option basics doesn't really make you effective in trading. What you really got to start to know is after you know what a vertical spread is, you got to get some really finite criteria, like what month to trade this option in, how far out of the money do I go. Just keep that in mind as you start coming through the learning curve, because that's ultimately what kind of separates people in options trading. And everybody knows what a vertical spread is. It's more how to actually functionally utilize that than anything.
Is there actually enough liquidity in the options market for, say, like the Russell 2000 in futures?
So, in the Russell futures, it's not huge. If I was going to trade the options on futures, I would predominantly utilize the ES options on futures. That being said, though, if you want to trade Russell, trade IWM, because those things are monstrously liquid, and they've got just killer bid-offer spreads in the IWM. For sure, I would trade the IWM, and I do myself, over the Russell options on futures there. The Russell futures themselves do not belong to the Chicago Mercantile Exchange, the CME Group. They've actually gone over to another exchange called the ICE. Since they went over there, their volume dropped off pretty considerably. That volume on those Russell futures isn't spectacular, and the options on futures is even worse. Mm-hmm. So moreover, listen, I don't care what product you trade, I don't care what exchange it's traded on. All I care is if it's if it's liquid enough and there's tight markets, I trade it, and I'll tell you. But I really feel the IWM kind of smokes the Russell futures and options for trading on a day-to-day basis.
Wonderful. Thank you for your input.
Yeah. All right. Thanks for giving us a call there, Randy. All right, so we're going to jump to another caller here in just a second. But if you are thinking about calling in, and hey, listen, the chat room is kind of quiet here today. So people in the chat room, at least talk about something in there. People are talking about oil and so forth. But, yeah, shoot in a question, talk to us, give us a call, 877-927-6648. With that, I'm going to jump to our next caller. It's Kevin in Jersey. You got a question about beta weighting. You there, Kevin?
Yes, I am, Don.
Hey, how you doing?
I'm pretty good. Pretty good. My question is the objective with beta weighting to have, if I'm using a lot of vertical puts and vertical calls, to have an equal amount with a positive theta? Is that the objective?
All right. So beta weighting and delta are two different animals, and what you're actually referring to is more delta neutrality. And that is simply this. If you sold a bunch of puts, for example, it makes you positive delta. You sell a bunch of calls or call spreads, it makes you negative delta. If you sold equidistant out of the money, the number of calls and the number of puts, it should make near zero delta. Now, delta is your directional risk. Theta is time decay, meaning that if you sold a bunch of calls, sold a bunch of puts, obviously time is decaying on your side. It produces positive theta. And at that moment in time, it has zero directional risk. Now, it's not, the name of the game here is not to create zero directional risk. The name of the game is to create any amount of directional risk that you're comfortable with. And I do actually heavily promote being positive theta, meaning I like when clients go out and sell premium. I find it's an easier, gentler world. Now, when I say selling premium, I'm more referring to trades that are lasting like a month. Like we just had a couple of callers that called in and they said, listen, I want to get in, I want to get out in the next 3 or 4 days. And I'm like, hey, fine, buy an in-the-money option. Fine, buy a spread. But when you talk about structuring option trades and building an inventory, those trades are anywhere from a month to 2 months to 3 months time horizon. Sell premium, manage risk is the name of the game. What beta weighting actually does for you, so beta weighting is taking one product and actually meshing it into another product. And what that means is, 1,000 shares of Apple does not equal 1,000 shares of Yahoo. But what you can do is you can turn Apple shares and Yahoo shares into a common metric, for instance, the Qs. And that's what beta weighting actually does. So you've got trades on like 6 different underlyings. You can actually weight them to one specific underlying, like an index, like the spiders. And I've got, a bunch of accounts set up here. I don't know if are you watching Tiger TV right now?
I don't have that, but I'm on my ThinkorSwim platform.
Yeah, so when you go to the monitor tab in the ThinkorSwim platform, there's a little checkmark box for not weighted, and you can weight things together. So you can literally weight one underlying to another underlying, and I've got Apple and Ford and GE and Google, and I've got a bunch of different positions in here. Here's one on Amazon and GE and 3M, and the aggregated delta equals 2,548, but that means nothing because what I'm going to do now is I'm going to beta weight that. Okay, so I'm going to turn apples and oranges into apples and apples. I'm going to beta weight everything to the spider. And when I do, it equals 1,400 spider deltas. So I turn, I turn the Amazon deltas into spider deltas, GE deltas into spider deltas. And this is stuff that's kind of esoteric, but at the same time, it's just essential to effective risk management, especially for a portfolio manager. The more understanding you get of the markets, the more essential something like beta weighting really becomes.
So basically, what I was asking was delta neutralization, more or less.
Yeah.
And that's not. You're saying no, but if you're selling out of the money puts on the spider, and you're selling out of the money calls, 2 or 3 strikes out.
Sure.
Let's say 20. Actually, I sold at 132, 133 this morning when the market was up. The call on the spider. Let me ask you a question. Is there a certain percentage in the probability of expiration that you want us to be in? Like right now, my probability of expiration is 22.66 of the 132. Is that a little light, or is that in a safe zone because expiration is next Friday?
Well, again, you're looking at a June option here, huh?
In June, I have a June. Right. I actually sold this morning the 132, 133.
So in terms of
I'm sitting on it right now.
In terms of like the time frame, you're selling options that are a little bit shallow, simply meaning that there's only like 10, 11 days left till expiration. Typically, when you really want to create a portfolio of options, you want to get some meat under you. You kind of want to sell more the July, like 38 days from now. But what you really got to focus on is once you learn to sell premium effectively, meaning that you put on a trade, it worked. You put on a trade, it worked. 3 or 4 expirations, you put trades on, and they tend to work. Win, lose, or draw, meaning they work. You saw time decay come out. Whether you made money or not wasn't really the issue. It's just that you got the trades on, you got a good understanding of them. What is critical is that you start to understand how options decay, okay, and how when things move against you, you really have to kind of stick to your guns and be at allocating. Once you get that side of the business down, then you need to get over what I call the curse of dimensionality, and that is simply don't just sell options in July or don't just sell options in June. People do that. They'll load up 50% of their capital into 1 month. You got to sell some premium in July, and then as July starts to mature, you sell a little bit in August. Before you know it, your working calendar spreads in July, September, July, August, and it's distribution of capital. So it's a capital allocation model that really you're achieving, all right, diversification via capital allocation. I know that sounds really
and you're also getting a higher return, providing it goes to your favor.
Right, and it's what that's the only way to effectively allocate when you're trading options. And let's say you have a $100,000 portfolio or more. I mean, man, $100,000 portfolio in pure options trading. That's a hell of a lot of trades. So the only way to effectively start to really allocate serious capital is to start to distribute capital into one or a handful of products and start to build an inventory, which means multiple trades spread throughout, for instance, the spider. So I sold, you're saying the 132, 134 spread. Then you go and sell, the 133, 135 spread. And you've already got the 126, 124 put spread and the 125, 123 put spread.
Okay, so actually mix it up more or less.
Exactly. The whole key is on this inventory, trade it super small, smaller than you would ever normally trade, meaning that it doesn't matter if you have $100,000 or $200,000 in your account. When you're first getting through the learning curve of the inventory management side of the business, you just got to blast off one lots and get the feel. And you got to step back from commissions and be like, all right, I'm going to blow some commissions. I'm going to have a little attrition rate in my account over here, but I'm going to learn how to distribute capital and start to build an inventory. And if you're on ThinkorSwim, there's a chat archive on the ThinkorSwim website. And there's a couple of chats that I've done in the past. One of them is called Building and Managing Inventory. Just type in my last name. It's under the ThinkorSwim website. It's under Support Chat Archive.
I've watched all yours 2 or 3 times.
Oh, fantastic!
I don't think I watched that one, but I watched all the other ones.
The next couple of days, I'm going to do a lot of that stuff on ThinkorSwim. It is past due. It is time for us to once again do a bunch of those chats there. So
okay, but as far as the 132, 133. With a 0.23 delta is 22% probability of expiration. Is that kind of lean is what you're saying? And the reason I did it was because next Friday's expiration,
right?
And I have a better chance. I understand there's more of a risk because you're risking more money to lose.
Right.
If the stock market takes off, which I doubt.
So here's the thing, though. You have very little time in here to allocate more capital. So if you're fine with this standalone trade and you've got a conviction that the markets are going to sell off, if you sell the 132, 134 spread, it's got a really low delta. If you've got conviction and just want to do a directional trade, that's fine. But when you're really starting to build an inventory, give yourself a little bit more time because the markets may correct a little bit against you. And, I'm not opposed to the trade that you did here at all. I would just like, hey, if it's an opening position, I'd rather see it out in July. It's not wrong. Just you get it. You're taking a little bit more risk.
But I like the spider because it seems that there's more bang for your buck in you're further out of the money. Where you're not one strike price out of the money, where you're biting your nails hoping that that it doesn't go up.
Right.
And this area, you could be 2 or 3 strikes out of the money, and you're still collecting a decent premium.
Absolutely. It's still a decent premium.
I like the spiders. You actually have turned me in the last few months from grazing on grass to starting to like salmon.
Yeah.
If you understand that.
Absolutely. Absolutely.
So now I'm actually, doing a lot of the selling the calls and stuff, and it's working out pretty good. So
excellent.
I just want to thank you for the information. I appreciate it, and I'll be listening to your TOS tomorrow. So.
Yeah, you know what? I think I might do the swim lessons. I might even do the Wednesday chat tomorrow, too. I'm home the next, 3-4 days, and I might as well do something here.
Yeah, because they're very informative. I really appreciate it, Don. Thank you very much.
All right. Thanks for giving us a call, Kevin. All right. With that, we're going to jump to the next caller. And for those of you guys holding on, we've got a bunch of calls in the queue here. But if you're thinking about calling in, you should. 877-927-6648. We're going to jump now to Joe in Boston. He's got a credit spread on the spiders. You there, Joe?
Yeah, Don. How you doing?
Good. How's it going?
Good. Thanks for taking the call.
Yeah, no problem.
I had a question. So I was looking at setting up a credit spread on the spiders for August.
Okay.
And I wanted to. I don't know. The way I was trying to set it up is if the market bounced a little, maybe up a little higher in the next few days. I was looking at the 133, 137 in August.
Okay. All right. So first question I got: why August?
Based on, I don't know. I just picked it because I thought the summer we might either consolidate or go lower. So I wanted to capture a little bit more time, perhaps time decay.
All right. So you're actually you're doing a 133, 137, which means you're probably buying this spread.
No, I was going to sell it. So I was going to try to take into credit. I didn't know if right now it's at about $1.20.
All right, let me just take a quick look because I want to understand exactly what you're trying to do here. So if you're selling a 133, 137 call spread in August, that actually would be a bearish trade because I thought you mentioned a bounce to the upside.
Yeah.
Okay.
Exactly.
All right. So if you're bearish, no, that's fine. That's fine. So the first thing that I'm not necessarily totally opposed to selling a spread out in August. Idealistically, if you're really a little bit bearish right now, it kind of makes sense to allocate a little bit to July and maybe a little bit to August as well. So that's just something to think about because there's already 38 days. I mean, there's plenty of meat to sell still in July. The other thing is you got a couple of holidays in July, and that is actually priced into the market there as well. You can see take a look at the July implied volatility. It's slightly lower. So the markets are absolutely efficient and amazing here that they actually price in. 4th of July holiday is priced in here. But the 133, 137 spread. So I'll just pull it up really quick here on my screen. 137 for about $1.20 or so credit. It's ideal. The probability of it staying, somewhere below about 133, it's about a 65% probability of success, associated with this. The one thing I'd keep in mind on this spread is you put it on, and if it's out as far as August, there's an extremely high likelihood between now and expiration that we touch and or exceed the 133 strike. It's called probability of touching. Something I usually don't talk about. When you sell spreads that are 70 days out, you've got to keep that in the back of your head. Although this trade has about a 65% probability of making some money, there's about a 70% chance that we're going to exceed the 133 strike between now and expiration. So that just means allocate accordingly. It means at some point this trade's going to look like a pretty, horrific animal to you, and hopefully you can hold on and make the trade profitable there, kind of through thick and thin as we rally up and sell off throughout the expiration.
Yeah. I was going to kind of try to just hold tight and see if we got a big update up into that range and put it on then. Right. I was just kind of going to sit tight.
I like that stuff. I'm a contrarian, so that makes sense to me. A lot of people say that, and they're like, "Are you out of your mind?" The biggest up day is when I get short.
Right. So if we got a 20 or 30 handle day up into that range, that would be the day I'd probably put it on.
Yeah, ideally, that's great. That's great. And if we get it really soon, you could still get it off in July if you want to try.
Now, do you have a simulator where you could say, okay, if we rally up to say 1320, 1325, what that spread will trade?
Absolutely. The easiest way to do it is right on the ThinkorSwim trade tab. Forget about the Analyze tab. The Analyze tab is the deep dark hole that takes an hour to really get into. So basically right on the trade tab. You on ThinkorSwim or no?
No, I'm not.
Okay. So on ThinkorSwim, there's a theoretical pricing calculator, and you can go onto ThinkorSwim.com and you can actually download the platform and just the paper trading platform for free.
Right.
There's a theoretical pricing calculator, and what it allows you to do is to basically simulate what if the stock, for example, moved up, you said 30 handles. So let's move the stock up $3. All right, so it actually shows you that the theoretical price of the 133, 137 spread moves to, X amount. And from there, you can, instead of just pricing the individual options, you can even tell the software, well, let's not price spreads. Let's go down and price physical vertical spreads. So the 130, for instance, 137, is that one we were talking about? 134, 137 here?
133, 137 in August.
Okay, it was 133, 137. Sorry, I had the 134 up there. So pull up like 4 strike over here. The 133, 137, for example, if we rally up $3, we'll go from $1.20 to a $1.78. That's assuming that it happens today. Then I can take the calendar and I can push the calendar forward, let's say to the, June 23rd. At June 23rd, this spread is still worth $1.70 based on a $3 rally. And that's, ultimately, you can do all that stuff on here.
Yeah, I had in my head a range, if I could, 170 to 180, if I could put it on in that range. That was the range I was thinking of trying to get in at.
Yeah, you're going to definitely need, though, quite the little rally on here. No question about it. You're going to need a $3 rally to get to the 170, 180 range on there, and that's anywhere in the next 2-3 weeks. Which, hey, you know what? I think in the near term, a lot of us are kind of bearish, though.
Now, what would that same, if you have time, what would that same position be on if that happened in the next week for July? Those same 2 strikes. What would that be?
I already unwound the whole thing. No, it's all right.
Oh, I'm sorry.
Back here. No, it's all right, man. I'll flip back really quick. So I'll pull it up here in July. The 133, 137 spread is currently trading in the month of July for 76 cents. If we were to rally up $3, so I'll put a $3 rally in here.
Wow.
Happened like today, it'd be $1.47. If it happened a week from now, which is by the 14th, it would be trading for $1.41. Nominal difference out there. Okay. So again, you're only talking about a 30-cent difference from one month to the other. There's a little bit of decay that's taking place in July, but not much to speak of.
Okay, so you like the July one better if you can get it on around 140?
I do. Okay. And I like the idea of you basically rallying and selling into that rally there. I'm a huge contrarian. That works for me.
All right. Thank you, sir.
All right, thanks a lot. Thanks for giving us a call. So with that, we're going to jump right to another caller here. And if you guys are thinking about calling in, we got plenty of time, plenty of callers. Give us a call, 877-927-6648. We are now going to jump to Michael in St. Paul, Minnesota. He's got a question about a covered call. You there, Michael? Oh, I am not sure he is there. All right. Got a couple of callers in here. See if we're still online with these guys over here. Got another caller here, and I know that I've seen this one before.
Hey, John, this is Mike.
Oh, okay. Sorry about that, man.
I'm here.
Hi, John. Hold there for a second. Yeah, fire away.
Say, I was just curious about your criteria for placing a covered call, and if you could kind of walk me through your steps.
Yeah. No problem. Equity or index product, not that it really matters. It's all the same stuff, but anything in particular you're thinking about?
No, I just want to understand what you're looking at.
All right, so typically with a covered call, the first piece of criteria is just a little odd that I always say this, but make sure you want to own the stock. And the reason I say that is, well, all too often people sell covered calls because they are trying to collect premium. And you're trying to collect premium, but you got to collect premium against the stock you actually you want to own. All right, so that's just a key logic that I try to get through to people. Make sure you want to own the stock. The next thing is basically selling a covered call is about just enhancing a stock position you already want to be in. So from there, you go out, you sell a call that gives you a little bit of upside potential. I don't like to sell at-the-money calls because it caps all the upside. Idealistically, you want to sell a call that's got about a month remaining to expiration. Any more than 23 days, you sell that one. Sell a covered call that's got around between a 30 to 40 delta, because that inversely gives you about a 60 to 70% probability that the option you're selling will expire worthless. I mean, that's ultimately what the covered call is. So you go out, if you opened up any option chain, and I've got a chain open right now. It happens to be on the spiders. I'll jump to the July options. and I'll just sift through an option. It's got between a 30 and 40 delta. I picked a 35 delta call on here. Done. A couple days before expiration, all you do is just buy back this call and sell another one. I mean, it's not about win, lose, or draw on the call. It's all about just banging out premium on a month-to-month basis.
Sure.
But the roll is easy.
What if you want to roll? Could you explain how you roll?
So the roll basically is a couple days before expiration. Just one piece of advice, I don't like to let a call expire worthless on a Friday and then sell another one on a Monday after expiration. The reason I don't is you give up a lot of time decay over the weekend, and for the most part, you'd be better off rolling them. When you're rolling them, it's just a matter of going in there, and I don't know if you're on ThinkorSwim or not, but you just right-click, go up to sell down a calendar spread, and what that does is it buys back for instance, the July option that you'd be short, turns around and sells the August option. You can switch up the strike prices to anything you want. When you're buying the 132s back, so in the spiders I was getting short the 132s. When you're buying back the 132s, it doesn't mean you have to sell the August 132s. You could sell the August 135s, because if the market rallied up a little bit, use the same criteria. In August, find an option that trades between, a 30 to 40 delta. So a roll is not always to the exact same strike. Make sure you kind of stick to your guns with your criteria there. All right. Makes sense? Yeah.
That makes a lot of sense.
Hope that cleared up a couple of things for you. And, feel free. If you got any follow-up questions, go for it, because you got me on the line right now.
I'll be calling you.
All right. That sounds great. Thanks for giving us a call today. All right. So with that, covered calls. A lot of people, they look at this, the covered calls as starting at the basics, but in the end, the covered call itself is one of the most important trades, really in your arsenal there, because not only is it really teaches a little bit more about the roll, but it's about banging out premium on an underlying that you've already got. So the question I have for everybody, if you guys listen to the show, is, if you're holding underlyings and you've been holding them for any period of time, 3 months, 6 months, you've got people that listen to this thing that's held this stock for 6 years, why wouldn't you sell premium against it? You got the right to. And don't worry about the underlying being called away. As long as you're not completely, incoherent at the wheel, if that option goes in the money, if it's at the money, if you're the slightest inkling that you're nervous that this stock could be assigned early, or the option actually be assigned, the stock get called away from you, just roll it right there to the next month. Watch out for some dividends. Dividends can always cause problems when you're selling covered calls, but ultimately, stick to your guns. Fire at will. Covered calls are pretty straightforward out there, but they really, really help you learn the concepts of basically selling premium and, of course, the roll, which is absolutely critical. With that, if you guys are out there thinking about calling in, give us a call, 877-927-6648. We've had a whole host of callers. I've not gotten to really much meat of what I've had kind of planned for today. So with that, I'm going to take a minute or two, go through this. Feel free to call in as I'm kind of cruising through a couple of ideas here today. Really what I wanted to talk to you guys about is, first of all, there was a trade I had mentioned last week that could still be a viable trade, and that particular underlying was Costco. So Costco, we were looking at doing a short position, just an idea. And by the way, whenever I talk about, a specific trade, and I have tendency not to do that much. Okay, when I do the option hour here, I don't like to usually take big directional biases. But from time to time, let's talk about an idea. It's a trade idea. So in Costco, we talked about getting short. Your opportunity is not nearly as good as it was last week, in that literally last Tuesday, what was that, like the 31st over here? 31st, we almost peaked out at like the 82 handle. It was a good time to sell like an 82-85 spread. So we've rallied just a little bit off the lows over here, but there's still definitely some what we believe is a little bit of downside to go on this particular underlying. So, keep an eye on things like Costco. I think it's an interesting short position there in one of the retailers. But, hey, listen, I still love to go to Costco. I can't, constrain myself from saying that. At the same time, it makes me want to get short. So, hey, I'm divided amongst myself over here. With that, I'm going to jump to another caller here. We've got Doug in Ohio. He's got a question about commodities. You there, Doug?
Yes, sir. Hi, Don.
Good. How's it going?
Going great. We got a local trading group here that loves ThinkorSwim, and we all use that and look at it mostly. But one of the guys that has been exploring commodity options, doing way out of the money, like a 10 delta or something, maybe 3 months out, and then kind of laddering them as time goes on, if that's the right term. And some looks intriguing. I'm just leery of commodities, so I wondered perhaps some thoughts on your, if you have any, or you always have thoughts, of course, but if where you might dig more, because it's not like a stock. They're not always event-driven. They're cyclical and seasonal. I just wondered if you had any insights that would help me understand those better, because it looks intriguing.
So the first thing that I always talk about in commodities is volatility. It depends on which commodities you're talking about, but implied volatility
is what he's looking at primarily.
Okay, so implied volatility of a couple of these commodity products, and I don't want to even get specialized. I mean, he's mentioned soybeans. Liquidity in there is, it's all right. I mean, the commodity that everybody's talking about right now still is silver, oil, obviously. It is really critical to keep an eye on the implied volatility because you can get out of hand very, very quickly. The other thing that you really have to start to understand in commodity products is what they call implied volatility skew. The skew is typically inverted in a lot of commodity products, and that can cause major, major issues, especially with a trade like an iron condor. Basically what a skew entails is this. If you look at the spiders right now and you thought about where is the most risk in the spiders right now, is it we crash to the upside or crash to the downside? Well, everybody's going to say, well, the risk in the S&P 500 is that we crash to the downside. Of course, we don't crash up, we crash down. Commodity products can be the exact inverse. Commodity products can have crashes to the upside, especially commodity products that are thin, meaning that the entire market cap in like a soybeans market isn't massive. So you can actually get limit up and limit down days where you hit literally circuit breakers and you do not have the chance to exit your position. I'm not opposed to trading irons like that, but I am really, I always strongly caution people that you understand the product fully and the terms of the product, which basically means what happens if this product moves drastically in a one-day period. Will this thing go limit up, limit down? And those are phrases that people have never heard, in recent times. What's limit up even mean? It means they basically lock down trading in that particular product. But you've got to take a look deeply into the product specs itself, how the settlement is, the total market cap of it. Try to trade. Not only, listen, even if the soybeans are massively liquid, they're still a relatively smaller marketplace, which can make them more susceptible to changes in implied volatility in a really rapid fashion. That being said, that's for iron condors, that's, a decent thing. The one, other I think I would kind of voice is this. Whenever you do a 10 delta spread, when you're selling that far out of the money,
he's actually doing naked puts.
Okay.
Not even a spread.
Be 100% certain that you could take a huge loss in that product at some point.
Yeah.
The reason that a 10 delta, trade, what it's going for, hey, if it's $1, it's because you're taking X amount of risk. Mm-hmm. And sooner or later, it's called a fat tail comes into play. A fat tail basically means, basically a strange or abnormal move. Fat tail basically in anything over like a 4 standard deviation move can be considered a fat tail. You have got to watch out for those in commodity products because they may only happen once, let's say, every couple of years, but that's all you need. One drastic move that happens to you in an overnight market and you're toast if you can't hedge that particular position. So just keep those things in mind because, obviously all of us traders, we've seen nightmares in products like that. And exactly the same trade you're talking about. Selling naked puts is great until it's not great.
Yeah.
Are you willing to get long soybeans at that particular level if the market completely, crumbles in that particular underlying? The thing is, selling naked puts in a commodity, in a lot of cases, is actually less risky than going out and selling naked calls. People think that selling naked calls in like the spiders is super high risk because it's open-ended risk, but the spiders can only appreciate so far so fast. But when you think about selling a naked call in a commodity, sky's the limit. If there's, for some reason, something happens to a crop, it's ridiculous how fast a commodity product can actually rally up. So keep that in mind. So you guys are definitely along the right lines. selling a naked put is a little bit less risk than selling a naked call, but inherently it's still got pretty drastic risks, especially dependent upon the product that you're trading.
Well, it piqued my interest just because I find my little private niche just selling puts on a stock I wouldn't mind owning.
Yeah.
Down around a 10 or a 13 delta. It's not. I can usually average somewhere around a little less than a 1% return in 30 or so days, which over a year isn't bad.
It's fantastic. It's absolutely fantastic. The weird thing about these commodity products too is, everybody's heard the phrase markets can stay irrational longer than you can stay solvent. Mm-hmm. Commodities are why we have that phrase.
Yeah.
So commodity products can be some of the most irrational products out there. And again, the cool thing though about the commodities is the margin. Oh, it's fantastic. You can load yourself up. It doesn't tie up much margin, which is usually the death of a lot of people, in this business. But hey, you know what? If you're comfortable with owning some of the commodities at those levels, go for it.
Okay, well, I'm just curious of your thoughts. I'm super conservative. I wouldn't be doing that right away until I did a lot of research.
Yeah, and again, the product specs in some of these things are absolutely critical. I mean, the only thing you got to look back at is silver. I mean, it just happened like 3-4 weeks ago. So you look back at silver. If you're comfortable with what happened with silver, and I'll pull up a chart over here really quick if you're watching the screen show.
Well, wouldn't you look differently? It's like a food, like with corn. Now,
right.
It could certainly crash up.
Right.
But what, it would be unusual. I can't even think of something would cause it to crash down, unless you found double the inventory somewhere in the world or something.
Right.
That makes sense, or am I just way off base?
Actually, no, it does happen. So the prices will artificially inflate, for X number of reasons, and out of nowhere, I mean, these markets go limit up 6 days in a row. The next thing you know, they're limit down 6 days in a row. That's exactly how it happens, too. So it's the move that you don't see coming that typically, hits that's where the train hits you.
Yeah.
When we're not looking that direction.
For ETS, like BAL for cotton and CRN for corn, I think.
Right, but really, when it comes to things like silver and soybeans, in the end, they're one and the same. And I understand one is obviously a crop, and the other one's a hard commodity out there. But ultimately, the function of the movement of the underlying is rational. Looking at both of those, but when silver went from SLV like 48 down to the low 30s, that was a scary move, very very scary move.
Great. Well, I love the platform and. Wonder if you're ever going to do it. I was fortunate to see maybe one of the last 2-day sessions up in Chicago that you were involved in. Any chance of those happening again?
More what I've been doing lately is some of the chats online, and it's just a lot more people. I think it's just more effective overall. It's instead of having 100 people in a room, they like to have 2,000 people in a room. But Tom Sosnoff and I have been kind of traveling around the country a bit, doing we call a little trader group roadshow. And those are similar. It's like a 3-hour class that Tom and I do, and I'm sure we'll get back to the Midwest here. We were just up in Seattle like last week. Those are great, fantastic, and it's really similar to what we used to do there years ago with some of the classes.
Great. Well, those Wednesday chats are always good. Not the Wednesday, but the.
Yeah, tomorrow I'm going to try to pick up a swim lesson. Tomorrow I'm going to do swim lessons. Thursday I'll do swim lessons. I'll do a Wednesday chat, I think, tomorrow. So we'll be busy. We'll keep you guys moving the next couple of days.
Great. Well, I appreciate your help.
Yeah, thanks for calling us, Doug.
Thanks, Don.
All right. So kind of wrap up for a couple of minutes here. We're getting close to the end of the options hour. A couple of things I really wanted to talk about. And you know what? So we had SLV up here, and I had written this down earlier. We talked a little bit about Costco, getting short Costco. Ultimately, I just wanted to jump into this. So on Costco, if you're looking for a short position, I'd actually wait possibly to the Costco rally back up into the 80 handle and try to get off the 80, 82.5 short call spread. So selling the 80s, buying the 82.5. For July. We rally even above that. You could even get off the 82.5, 85 spread, and keep it to a $2.50 spread. Again, I'm usually not directional in some of the equities, but there's a couple of underlying equities here that are just way overdone, Costco being one of them. So we may see a little bit of a bounce from this sell-off over here, and you could actually possibly sell into that bounce there from that sell-off. So that's a little bit about Costco. So I'm going to jump back to SLV here for just a moment. In SLV, I saw an interesting opportunity arise in SLV, and that's simply that the implied volatility is starting to contract. The implied volatility in the last couple of weeks has been right around 52. You could look for something like an iron condor in SLV, which is an unusual trade in a commodity like this. The iron condor basically, for example, selling the 40s, buying the 42 calls, maybe selling the 32 puts, buying the 30 puts. So let's actually pull that up really quick. We'll come up to sell down to iron condor. This is a kind of a market neutral trade on here, selling the 40s, buying the 42s. And I think I mentioned the 32.30 strike over here for the month of July for about a 62-cent credit. It's got about $1.38 of risk in this particular trade. But it's interesting because you've got decent implied volatility over here. And we're really stagnating sideways right now. We're just channeling up and down. Could be an interesting, trade here for like the next month or so. We've got 38 days left in July. Assuming that you don't think silver's going to explode one way or the other here, iron condor could very well be interesting. So, coming up in these shows in the next couple of weeks, I love giving some different trade ideas. The summers tend to get a little slow, so let's make it interesting. With that, of course, I will be back next week for the options hour, and I appreciate all the different callers that we had in today. Give us a call back next week. Follow-up questions, fire at will. Again, the options hour is 1 p.m. Eastern Standard Time every Tuesday afternoon over there. My name is Don Kaufman from ThinkorSwim from TD Ameritrade. I've enjoyed talking to a bunch of you guys today. Thanks a lot, everybody, and have a great day. Bye-bye.